Today, global financial markets are once again facing a moment of tension and uncertainty. The phrase, Monday sell-off, has begun circulating across trading floors, financial newsrooms, and investment circles. It refers to a sudden wave of selling pressure hitting markets at the start of the week, and this time the scale is massive. Reports suggest that systematic funds, those powerful, algorithm-driven investment vehicles, may be dumping as much as $36 billion worth of assets into the market. To the average investor, this may sound alarming, but it reflects something deeper about how modern financial markets operate. Unlike traditional investors who rely on long-term analysis or emotional judgment, systematic funds rely on data models, volatility signals, and automated strategies. When certain market indicators trigger risk alerts, such as rising volatility, falling momentum, or shifting macroeconomic signals, these funds respond almost instantly. What we are witnessing is not just ordinary selling. It is a coordinated reaction from algorithmic systems designed to protect capital during uncertain conditions. When these funds begin selling at scale, it can accelerate market declines because their trades often happen simultaneously across global markets. However, moments like these also reveal an important truth: financial markets move in cycles. Periods of selling pressure often follow long stretches of optimism. What looks like panic on the surface may actually be disciplined risk management by large institutional players. The key question investors are asking today is simple: is this the beginning of a deeper market correction, or just a temporary reset before the next rally? While no one can predict the exact outcome, history shows that volatility is an inherent part of the market's evolution. Understanding why these systematic funds are selling is crucial. It tells us not only about current market stress, but also about how automated strategies now influence billions of dollars in capital flows. As technology continues reshaping finance, these algorithmic decisions will play an even greater role in determining market direction. Systematic funds have quietly become one of the most powerful forces shaping modern financial markets. Unlike traditional investment funds where portfolio managers rely on experience, intuition, and long hours of research to decide what assets to buy or sell, systematic funds operate through complex mathematical models and automated trading systems. These models analyze vast amounts of financial data in real time: market trends, price momentum, volatility levels, interest rate movements, macroeconomic indicators, and even global sentiment signals. Based on this data, algorithms determine when to enter or exit positions without the need for human emotion or hesitation. Over the last decade, the size and influence of these funds have expanded dramatically. Institutional investors such as pension funds, sovereign wealth funds, and large asset managers increasingly allocate capital to systematic strategies because they promise disciplined, rules-based decision-making. By removing emotional bias, fear during downturns, or overconfidence during rallies, systematic funds are designed to follow strict risk management frameworks. This approach can help protect capital during turbulent periods, but it also means that when certain market signals appear, these funds react quickly and often at massive scale. One of the defining characteristics of systematic funds is speed. Because their strategies are automated, trades can be executed in fractions of a second across multiple markets simultaneously. When risk models indicate that exposure needs to be reduced, billions of dollars can be sold almost instantly. This speed creates a powerful ripple effect across financial markets. What might begin as a modest decline in stock prices can quickly accelerate when large systematic players begin reducing positions all at once. The current discussion about a potential $36 billion sell-off highlights just how significant these funds have become. Many of the largest systematic strategies manage tens or even hundreds of billions of dollars individually. When multiple funds operate under similar models, tracking volatility, momentum, and trend signals, their actions can become synchronized. If the same indicators trigger risk warnings across several funds at the same time, the result can be a coordinated wave of selling that overwhelms normal market liquidity. Another important factor is diversification. Systematic funds rarely focus on a single asset class. Instead, they operate across global equities, government bonds, commodities, currencies, and sometimes even derivatives markets. Their models continuously adjust allocations depending on which assets appear strongest or weakest according to their algorithms. When market conditions shift, these funds do not simply sell one asset. They often rebalance entire portfolios simultaneously. This means a sell-off in equities may also coincide with movements in bonds, commodities, or currency markets, amplifying the overall impact. Many systematic funds also follow strategies such as trend following or risk-parity, which aim to balance exposure across assets based on volatility. These strategies often increase positions during stable markets because lower volatility allows for higher allocations. However, when volatility begins to rise, the same models quickly reduce exposure to maintain their targeted risk levels. This dynamic adjustment is central to why large waves of selling sometimes appear suddenly after long periods of calm market conditions. The growing dominance of automated trading has also changed the structure of financial markets themselves. Decades ago, most large trades required direct human decision-making and manual execution. Today, Algorithmic systems handle a significant percentage of daily trading volume on major exchanges. Systematic funds are a key part of this transformation. Their reliance on data and technology allows them to process information far faster than any human trader could. Because these funds rely on similar types of indicators, such as price momentum, volatility thresholds, and technical trends, they often respond to market signals in similar ways. When volatility rises or trends reverse, many of these algorithms generate sell signals at nearly the same moment. This synchronization can create powerful market moves as large volumes of capital are withdrawn from risk assets within a short period. In situations like the current Monday sell-off scenario, the sheer size of systematic funds means their actions can influence the broader market direction. Other investors often watch these movements closely. If they see large institutional flows leaving equities or other assets, it can shape their own expectations about future market conditions. In this way, systematic funds not only react to market trends, they can also help create them. Ultimately, the power of systematic funds lies in their combination of scale, speed, and discipline. They represent trillions of dollars managed through algorithms, designed to respond instantly to changing market conditions. While this approach can stabilize portfolios during uncertain times, it also means that when risk signals appear, the resulting market reaction can be swift, dramatic, and highly visible across the global financial system. One of the most important forces behind large-scale selling by systematic funds is the sudden rise in market volatility. In financial markets, volatility represents the degree to which prices move up and down within a certain period of time. When markets are stable and price movements are small, volatility is considered low. But when markets begin swinging sharply in both directions, volatility rises, signaling uncertainty and increased risk. For systematic funds, volatility is not just an observation. It is a critical signal that directly influences their trading decisions. Most systematic funds are built around strict risk management frameworks, known as volatility targeting. These strategies aim to keep the overall risk of a portfolio within a predefined level. When volatility is low, the models allow the fund to hold larger positions in risk assets such as stocks, commodities, or high-yield bonds. The reasoning is simple: if markets are calm, larger investments can be held without exposing the portfolio to excessive risk. As a result, during long periods of market stability, systematic funds gradually increase their exposure to equities and other growth-oriented assets. However, the moment volatility begins to climb, the situation changes rapidly. Rising volatility signals that price movements are becoming unpredictable and potentially dangerous for large positions. To protect investor capital, the algorithms that govern systematic funds automatically begin reducing exposure. This often involves selling equities, reducing leveraged positions, or shifting funds into safer assets such as government bonds or cash equivalents. The selling process is typically mechanical and immediate. Unlike human investors who might debate the situation or wait for more information, systematic funds follow predetermined rules coded into their models. When volatility crosses certain thresholds, those rules trigger automatic portfolio adjustments. The higher the volatility rises, the more aggressively the models instruct funds to cut risk. This can result in billions of dollars being sold in a very short time frame. What makes volatility-driven selling particularly powerful is that it often creates a self-reinforcing cycle. When systematic funds begin selling assets to reduce risk, their trades push market prices lower. Falling prices, in turn, often cause volatility to increase further. As volatility continues rising, more systematic strategies detect the change and trigger additional selling. This chain reaction can accelerate a market decline far beyond what might have occurred from the initial volatility spike alone. In addition, many different types of funds rely on similar volatility signals. Volatility targeting funds, risk-parity strategies, and commodity trading advisors frequently use comparable mathematical models to determine appropriate levels of market exposure. Because these funds monitor the same indicators, such as the standard deviation of price movements or volatility indexes, they often react at nearly the same moment when conditions change. When dozens of large funds respond simultaneously, the combined selling pressure can be enormous. Another factor that amplifies this process is leverage. Some systematic funds use borrowed capital to enhance returns during stable market periods. When volatility increases, the risk associated with leveraged positions becomes significantly higher. As a result, models require funds to rapidly reduce leverage by selling assets. This deleveraging process can add another wave of selling to an already fragile market environment. Volatility spikes can also be triggered by external events such as unexpected economic data, geopolitical tensions, central bank policy shifts, or sudden changes in investor sentiment. Once volatility rises sharply, systematic models treat it as a signal that the market environment has shifted into a higher risk phase. Even if the underlying cause of the volatility is temporary, the models still respond according to their programmed rules. In the case of a large Monday sell-off scenario, markets may already be entering the week with heightened uncertainty from the previous trading sessions. If volatility measures jump early in the day, systematic funds begin executing their risk reduction strategies immediately. Because these funds operate across global markets, their actions can quickly spread from one region to another. Selling in one market can influence futures markets, which then impact trading behavior in other regions as markets open throughout the day. The rapid speed of modern electronic trading platforms also plays a role in amplifying volatility-driven selling. Algorithms can analyze market conditions and place trades in milliseconds, far faster than human traders could ever react. This means that when volatility thresholds are triggered, the response from systematic funds can be almost instantaneous, adding large volumes of sell orders into the market at the same time. For many investors watching from the outside, these sudden waves of selling can appear like panic. Prices drop rapidly. Headlines begin to warn of massive capital outflows, and market sentiment turns cautious. However, in reality, much of the activity is not emotional at all. It is simply the result of automated risk management systems performing exactly as they were designed to do. In modern financial markets, volatility acts like a signal that determines how much risk systematic funds are willing to hold. When markets are calm, these funds become powerful buyers, helping drive long-term upward trends. But when volatility rises sharply, the same funds transform into major sellers almost overnight. This shift from aggressive buying to rapid selling is one of the key reasons why volatility spikes often lead to large and sudden market declines. Another critical factor driving the current sell-off is the behavior of momentum-based models employed by many systematic funds. Momentum strategies operate on a relatively simple but powerful principle. Assets that have been performing well in recent periods are likely to continue performing well in the short term, while those that have been underperforming are likely to continue underperforming. Systematic funds using these strategies constantly monitor price trends, technical indicators, and relative strength metrics to identify which assets are winning and which are losing. Their algorithms then allocate capital accordingly, increasing exposure to assets showing upward trends and reducing exposure to those showing weakness. While momentum investing can amplify gains during steady upward markets, it also works in reverse when market trends reverse. When prices of previously strong assets start to falter or key technical indicators, like moving averages or trend strength indexes, show a weakening trajectory, the algorithms interpret this as a signal to exit positions. The decision to sell is entirely rule-based and occurs automatically, without human hesitation or deliberation. This allows systematic funds to respond almost immediately to trend changes, but it can also accelerate price declines once multiple funds react in the same direction. The impact of momentum reversals is particularly pronounced in today's market because so many systematic funds employ similar models. Many of these funds track comparable indicators, use analogous trend thresholds, and monitor the same global indices and asset classes. As a result, when momentum signals flip from positive to negative, multiple large funds can initiate sell orders simultaneously, generating a concentrated wave of selling across equities, bonds, and commodities. This synchronized behavior amplifies the market impact far beyond what a single fund could achieve on its own. Momentum-driven selling is further intensified when combined with other algorithmic triggers such as volatility spikes or risk limit breaches. For example, a stock showing early signs of declining momentum may also begin exhibiting higher volatility. This can simultaneously trigger multiple layers of algorithmic responses: momentum-based selling, volatility, targeted reduction of positions, and risk-parity adjustments. When these triggers converge, the resulting sell-off can appear sudden and severe, catching even seasoned human traders off guard. Another nuance of momentum strategies is their sensitivity to short-term price reversals. Systematic funds are often designed to optimize short to medium-term performance, sometimes over a period of weeks or even days. When market prices reverse quickly, algorithms detect the trend almost instantaneously and may initiate outsized sell orders to prevent further losses. In this way, momentum models not only follow trends, they can exacerbate short-term price swings by amplifying moves already in progress. The psychological effect of momentum-based selling is also significant. As systematic funds unload large positions, other investors, both institutional and retail, observe the price drops and often interpret them as confirmation that a market trend is reversing. Human traders, unlike algorithms, may hesitate initially but tend to follow visible signals. This creates a feedback loop. Algorithmic selling triggers human selling, which in turn reinforces downward momentum, prompting even more systematic funds to adjust positions. Finally, momentum strategies are highly sensitive to cumulative market behavior. In markets that have experienced extended periods of growth, systematic funds may hold relatively large positions because prior trends have been strong and persistent. When momentum signals flip, these sizable positions must be reduced quickly. The unwinding of large positions across multiple assets can dramatically accelerate market declines, turning what might have been a moderate correction into a sharp sell-off. In essence, momentum models act like a double-edged sword in today's markets. They provide a disciplined framework for capturing trends during stable periods, but when trends reverse, they can trigger rapid, large-scale selling. This automated response contributes to the intensity and speed of market declines, explaining why sudden shifts in momentum can have such a pronounced effect on overall market stability. The actions of systematic funds do not occur in isolation. They reverberate across the entire global financial system, influencing markets far beyond where the initial trades are executed. When large-scale selling occurs, such as in the current 36 billion sell-off scenario, it sets off a chain reaction that touches equities, bonds, commodities, currencies, and even derivative markets worldwide. Systematic funds often operate globally, allocating capital across multiple regions simultaneously. This means that a sell-off triggered in U.S. equities can ripple immediately into Asian and European markets as automated algorithms adjust positions and human investors respond to price movements in interconnected markets. One of the key mechanisms behind this global impact is the psychological effect on other investors. Large, visible waves of selling can act as a signal to the broader market that something is amiss. Even when the original selling is purely mechanical, driven by volatility thresholds, momentum reversals, or risk-parity adjustments, retail investors, discretionary fund managers, and other institutions may interpret these moves as a warning sign. This can prompt additional selling from participants who are not following systematic models, but are reacting to price movements, market sentiment, or fear of losses. Consequently, a sell-off can expand far beyond the initial automated trades, becoming a broader market correction. Systematic funds also interact with other trading strategies, including high-frequency trading, arbitrage, and hedge fund operations. Many of these strategies rely on price differentials, market liquidity, and short-term trends. When systematic funds begin dumping large positions, they can temporarily distort market prices and liquidity, creating opportunities for other traders to adjust positions or hedge risks. This can amplify volatility further, especially in markets that are already thinly traded or sensitive to large capital flows. Currency and bond markets are also heavily influenced. For example, if systematic funds reduce exposure to risk assets, they may shift capital toward safer investments, such as U.S. Treasuries or gold. This sudden inflow into safe, haven assets can strengthen certain currencies, depress bond yields, and create dislocations in markets that are highly sensitive to capital flows. Similarly, commodity markets, oil metals, and agricultural products can experience rapid price swings as funds adjust positions based on algorithmic signals tied to risk and momentum. Another important factor is timing. Systematic funds operate around the clock, with algorithms constantly scanning global markets for signals. As a result, a sell-off in one region can trigger immediate adjustments in other regions, even before their local markets open. For instance, selling pressure in U.S. markets on Monday morning can influence European and Asian futures markets during their overnight trading sessions, creating preemptive price adjustments that cascade into the new trading day. The broader economic implications are significant as well. Large-scale sell-offs can influence investor confidence, corporate funding costs, and capital allocation decisions. If markets experience sharp declines, companies may delay investment or expansion plans, central banks may monitor financial stability more closely, and global investors may reevaluate risk exposures across entire portfolios. Even short-term systematic selling can have lasting consequences if it alters expectations about market direction or introduces heightened caution among participants. Finally, it's important to note that the impact of systematic funds is cyclical. While their selling can temporarily exacerbate market declines, the same automated systems can also act as stabilizers when volatility subsides or momentum signals improve. As models detect that risks have abated or trends have stabilized, systematic funds may begin reallocating capital back into markets, providing liquidity and support. However, during periods of intense volatility or negative momentum, their selling amplifies declines, illustrating how these funds are both a powerful force for efficiency and a potential source of rapid market movement. In summary, the actions of systematic funds have a global dimension. Their trading decisions not only affect the assets they directly hold, but also influence investor behavior, market liquidity, and capital flows across regions. The ripple effects of automated selling can transform a local or sector-specific adjustment into a global market phenomenon, highlighting the interconnectedness of today's financial system and the outsized influence of algorithm-driven capital.